It's safe to come out from under your desk. I know last week we brought you some crazy financial horror stories. Halloween's over. Now we're going to be talking about IUL. November is IUL month here on the Life Insurance Financial Education Podcast. We're going to talk about what it is and give you a brief rundown of the history of the IUL, because our goal here is to pull back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Vaquero with NetWealth Finance.
All right, the IUL, brief history of it. Well, I mean, what it is, it's a indexed universal life insurance policy. It's cash value life insurance built on the universal life chassis. How this came about has to do with what was going on in the U.S. at the time. Like the rumblings of it kind of started back in the 70s.
Yes, so in the 70s, the lower returns of whole life weren't as competitive with much of the different things that were going on, and inflation was a factor. Market returns could be relatively high in comparison. So the insurance industry was trying to stay competitive with the broader financial industry.
Now, we say the lower returns in whole life, but the returns were actually really high in that time period. It's just that inflation was so high during a part of the 70s that it just wasn't as competitive as it needed to be. And insurance companies were struggling because people were able to take out policy loans at a well below market rate that they could then go just put that money into a savings account and earn incredible interest because of the inflationary environment at that time. So insurance companies were basically having financial difficulties due to this mismatch, and they had to come up with some type of a solution. And that solution was?
Well, universal life was the solution, and it allowed for a little bit more premium flexibility and also this more flexibility in how they could play with the crediting rates.
Yeah, the crediting rates were able to be declared by the insurance company. And essentially, it gave them a lot more freedom from the higher guarantees associated with whole life insurance. And that's in large part due to the flexibility of the designs. They wanted to decouple having to pay a really high premium every single year, which is basically what whole life does. You're locked into paying a base premium every year. And they wanted to make that flexible in order to have a competitive product in that marketplace.
And one of the ways that they do that is by being built on top of annual renewable term. So the insurance rates are not as fixed as they are with a whole life product.
Yeah, they're not front loaded to help make sure that they can cover the cost of the insurance at that tail end of the policy when the cost of insurance is actually really high. So universal life, built on annual renewable term insurance. Cost of insurance is very inexpensive when you're young because the cost is based on what's the likelihood you're going to die this year. Well, if you're young, the odds aren't very high, so they don't charge you very much for it. But when you get older, that's when things start to become a problem. Now, they didn't really recognize this at the time, or else they didn't really care too much at the time as long as they could sell some policies. So the UL had its heyday where it was very popular, but the popularity waned as more and more people got involved with the stock market and 401ks took off and people got more familiar with what's out there for investments. And life insurance companies saw a decline in relation to the amount of money that people are putting into the stock market. So they had to come up with another solution.
That's where they brought in variable universal life, which has a direct market component. So with that, you have the potential upside of market returns, but you also have that potential downside with that VUL.
The challenge with the VUL, though, is insurance agents can't sell it. You can't sell it unless you're licensed to be a stockbroker. Well, there's a lot more tests that go into doing that, and a lot of people can't pass those tests, and they needed something else that was decoupled from the stock market itself. Well, the market, you could say, demanded it. People didn't really want to be in universal life, and they may not have wanted the exposure to the stock market that VUL offered? The answer to that, indexed universal life, where you've got the upside potential, but the downside protection from the drops in the stock market. And that kind of brings us full circle to where the IUL has become extremely popular and one of the dominant policy types being purchased today in the life insurance space.
And I think that's for good reason, because it really does, in my mind, serve a good place in a pretty broad set of people. You can have very high funding levels for people who might be maxing out their retirement accounts, but you can also have pretty low funding levels and still have good cash value growth. And it is a really great option for those that may not be wanting to lock up too much funds into retirement accounts that they might have to pay penalties for if they have to access those in an emergency.
The big advantage I see in the IUL is the ability to put in a good amount of money while the cost of that insurance is very low. In whole life, you've got a long period that you're making up for the high expense of the insurance because they have to make sure that that policy is able to continue paying for that insurance when you get into old age and the cost of insurance is very high. Well, they spread that out throughout the life of that whole life policy. That doesn't happen in the IUL. You're going to pay a low cost for the insurance when you're young, and that cost is going to get expensive when you're older. You have the option, the flexibility to change how much you want to actually pay for when you get older. So if you still want to pay for a whole lot of insurance when you're older and it's expensive, you can do that. But a lot of us don't want to do that. And so we reduce the amount of insurance when we get into old age and the cost is more expensive, having already built up that cash value back when the cost was very low. And that's really the space that we thrive in here as agents. We thrive in designing high early cash value policies that can build cash when that cost is cheap and reduces the expenses when we get older so that we're never paying astronomical costs for insurance, which you inevitably would if you were paying for a lot of death benefit in your 80s and 90s.
Yes, and we've used the term before. It's that guideline minimum premium that you pay in, and when you do reduce it to that in your 70s or 80s, if you've built up a good amount of cash value, the expenses in that policy at that guideline minimum can be very low in comparison to what your crediting is, even well covered by guaranteed rates in our favorite product.
Now, there have been a number of changes to these products over the years, regulators coming in and putting the hammer down on the way these things have been sold. There were a lot of years that there weren't very much regulations around how these got sold. And realistically, they were not being designed very well. They were very expensive products. And rightfully, there were a lot of lawsuits.
Well, and that's because people were able to illustrate very high numbers for just steady returns for the rest of your life, double-digit returns for the entire life. And that's just too much when you consider for various factors. It's not to say that you couldn't potentially see an average maybe in the double digits over the life of the policy, but to have that as an illustration of a solid, safe return that you can reasonably expect for the rest of your life, that's a little bit unrealistic. And I think that's where a lot of those lawsuits came from.
Yeah, and then they came out with regulations as far as what can be illustrated, because there are a lot of insurance companies, their number one goal is to sell policies. Keeping customers for decades, not so important. Making sure that they're making money in their policy, not so important. You would think that it would be. I think the best companies out there ensure that they have good products. They want to see their clients making money in those products because they're going to keep paying for the insurance. But sadly, I don't think that's the case with all of them. And so you do see some unscrupulous business practices. They're all going to push the envelope in order to remain competitive. It is a cutthroat industry after all. So it's kind of on us as agents to identify what companies are being realistic, what companies tend to treat their clients best over the years and not just sell them a product and basically let that product deteriorate.
And to put in some protections on the broader industry, that's where they came up from a legal perspective of these AG 49 and a few updates to it. So AG being actuarial guidance laid down some foundation for how policies in IULs can be illustrated. And so that's not to say that it's perfect, but it is a lot better for being more conservative with illustrations than some of the things in the past.
Yeah, there's a constant push and pull between industry and regulators with what they're able to show as projections. Now, some of the best products out there have averaged well over 6 or 7% for the life of what they've had to offer for index options, but illustrating those kind of sets some unrealistic expectations, I think, because of the flexibility that these policies offer. Like, I don't know if my client is going to constantly change index options and potentially choose the worst ones every single year. I don't know if they're going to move money into the fixed interest account. I don't know if they're going to fund it at a level that will support that policy throughout the life of the policy. Like, you have so much flexibility as the owner of these to change what you're doing inside of it that an illustration can go right out the window as soon as the policy is issued.
And it becomes difficult as well, especially like in my own IUL and our own IULs, some of them, we have this lock feature where maybe you lock too early because it's been a down year for 8 months and you decide, oh, I'm suddenly getting single digit return, and then suddenly you lock and it spikes. So there's various things that could happen that could, we as people can really not predict the future. And that's really when you're tied to the markets, all of us can make mistakes, and there's no way that, we can protect anybody from themselves or even our own self from getting nervous about returns sometimes.
Yeah, and I do need to point out, at the base level, the IUL does give us access to growth in the stock market via particular index options. And there's a whole host of index options offered by various companies. Certain companies will specialize in certain index options. And so you could get exposure to the S&P 500. You might have exposure up to a certain amount. We call that a cap. You might have exposure that's based on a spread, or it could be credit based on a participation rate. Then you have volatility indexes that are a whole beast in and of itself, where the insurance company partners with a particular bank or investment company, and they will sell them options on a specific index. And these things are not available to the general public. So it can get very complicated on the back end with how they get these things designed and what's available to you as far as what index options and how it can grow inside of it. And these have all come about due to market demand. They constantly need to innovate in order to have an attractive product that gives you the ability to get growth inside of it. Now, as far as the insurance companies go, they have an options budget that's going to go to spend on these options, no matter which ones you end up choosing. So ultimately, they do want you to be successful when it comes to your investing, but they are going to be limited based on how much they can put into that options budget. And some carriers have way bigger options budget than other carriers do.
And that's because within these insurance companies, they're still they're directly investing in very secure assets, very similar to what you will see in whole life. These secure assets will pay a yield, which then in turn becomes the options budget. So companies that have stronger general accounts will have stronger ability to have a yield that can establish a bigger budget for those options.
Yeah, so just as an example, if your insurance company has a general fund that they know, because it's built on bonds, long-term bonds, they know that they're going to make 6% over the next year in their general fund account. And their operations budget is about 1%. So that leaves them with 5% growth that they know that they can have if they take $100,000, if they take 5% of that as the options budget, they know that next year, the amount of money that they pulled that $5,000 from will grow back to $100,000 based on the growth of their general fund. So every single year, if their general fund is making that 5%, they know it will recoup whatever they're pulling for that options budget. So they know we've got 5% to spend on these options. So the fluctuation among participation rates and caps and spreads will just depend on what does that 5% buy in any given year. So it's not magic how these things work. Their options budgets are figured out in advance. And essentially, the companies that have the best performing general funds will generally offer you the best options budget. There's a direct correlation there. And when they start to hurt, when these insurance companies start to hurt, when interest rates get very low for a long period of time, we see cap rates and spread rates and participation rates all come way down. We're in an environment right now where the interest rates are up, and we've seen cap rates and spreads and participation rates all rise. And it's a great time to be in these products. But just know they may not stick around. If we end up in a tough interest rate environment again, those can contract. But it doesn't mean that these products can't be successful.
Even in those low interest rate environments, they can be very successful. And I think that when I got my IUL, the interest rate environment was certainly a low interest rate environment, and it was still attractive for me to get into my policy. So it's not like these are bad in low interest rate environments. There's various things that make them still a great option for a lot of people. And it's hard to say what's going to happen in the future because we don't know, but we'll see what happens. I'm confident that my IUL will be strong going into the future.
Yeah, I think a lot of it will just depend on the expectations that are set when it's sold. So I think a realistic expectation with a lot of these products is 5 to 7%. If we can get 5 to 7%, not have the downside risk of the market, you're probably going to be pretty happy with your product. But if you get 5 to 7% and you were sold telling you that you were going to get 10 to 12%, you're probably not going to be very happy.
Yep, exactly. And I think that's where we try to focus in on that is level setting expectations and illustrating at more conservative numbers in order to set those expectations.
I think that wraps it up for IUL, what it is, brief history of it. Appreciate you joining us for this. Next week, we're going to be talking about IUL as a diversification tool and a volatility hedge. These have great potential to complement the rest of a financial portfolio in certain ways. So be sure to come back for that. Do you have a call to action for our folks this week?
It's time for this week's call to action.
So we will be posting this full report that was AI generated on our Substack and possibly also on our website. So check us out. Lifepod.us is the website, or on Substack, lifepod.substack.com. We're posting episodes in audio format there as well, and trying to also put out various types of content on our Substack. So if you want some extra information, that is a good place to start.
So what we did was we had Gemini run a deep research report on the IUL and the history of it. And it's like a 25-page report that's going to be up on the Substack and our website. So if you really want to dive into the history of these, it's pretty fascinating. I think that's a great call to action. And with that, I'm James Barber, your Oregon Cash Flow Pro. I'm licensed for life insurance and annuities across the country.
And my name is Carlo Vaquera. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with life insurance clients across the country as well.
Take care. We'll see you next time.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.